Welcome to Fitch Ratings Fixed Interests Podcast. My name is Justin Patry. The US housing market is arguably one of the most important sectors in the world, linked closely to the state of the world's largest economy and with many industries reliant on its health. So, how is the outlook for US housing faring amid rising economic uncertainties? To answer questions on the state of the US housing economy, today I'm speaking with Olu Sonola, Chief US Economist for Fitch Ratings, and Sarah Repucci, Senior Director in our Credit Commentary and Research team, both based in New York. So, Olu and Sarah, you've just published the latest US Cross Sector Housing Monitor, which is a report that provides a view of the housing sector from a variety of different perspectives. What is the state of the US housing economy heading into 2025?
I can take that, Justin. Thanks for having me on the podcast. I think that I should start by, first of all, letting people know what we mean by the housing economy. It's our attempt at comprehensively looking at all aspects of residential housing in the United States. It's a big chunk of GDP. It's about close to 20%. And it does incorporate three components. The first is the good side of things. So you're buying furniture, you're buying household related durable goods. The second is services. So housing services, mostly rent. And the third is residential investment. So construction, remodeling. It's all of that. It's the totality of that we're calling the housing economy. Now, in terms of what it's done in the last, say, year and what we're looking ahead to over the next year, I would say in the last year, it's done quite well. Its growth, annualized quarterly growth rate has averaged about 2%, just shy of US growth rate. And looking forward, we're expecting a slowdown, but as Justin just mentioned, lots of risk there. There's a lot going on in that space. Tariff is front and center, as we all know, and that many of our key components come from there. You still also have to talk about immigration and many other things. The whole notion of sentiments. So I'll stop there for now. There's a lot to talk about on this subject, but I think even though we have a growth rate of about 1.5%, between 1.5 and 2 in our outlook, my conviction, I can't say is very strong, given everything that's going on.
Yeah, could you develop your points about the risks to the housing economy? So you mentioned a few, but can you maybe tack down what are the three largest risks you see to the housing economy? Is the risk bias to the downside or the positive? How to what extent could you see your forecast is affected by the largest risks to the housing economy?
Uh, to a large extent, I think, as I just mentioned, the whole tariff scenario and the ripple effect of the trade war. So it's a global trade war now. Markets are reacting, investors are reacting, um, consumers are starting to react. We're seeing pockets of weaknesses. That will spill over into the housing market. So if you start with tariffs, I think the first thing you have to say is a big chunk of what we use to build homes in the United States comes from outside of the US. A big chunk of those household appliances that I just talked about that people buy when they remodel, when they buy a new house, comes from outside the United States. So if you're talking about tariff rates of 20, 30, 40%, that's mind blowing. And clearly, most of that will be passed on to the consumer, and the consumer will have to contend with that. So that has very, very significant downside risk. You already have affordability issues. This adds to that. The other point I will talk about is more from a home builder standpoint, and that is immigration. So labor supply, people that build home builders, labor supply is very critical to what they do. If they can't find people to do the job, they can't do the job. It's just that simple. So we do have a much tighter immigration policy, and many of the people that do the work, many of the people that are in that construction business, are probably going to be in the crosshairs of a clampdown in immigration. And in that report, we do have a chart that basically shows that almost a quarter of people in that industry, in the construction industry, foreign-born non-citizens. And if you look at key specialties in that industry, some you're talking about numbers to the tune of about 60%, half, and even more of key specialty construction jobs done by um, foreign-born non-US citizens. So to the extent that people stop showing up for work, we will see a slowdown in construction activities as a result. The final point I would make quickly is, and this is probably one that is quite unpredictable, is how consumers will react. Sentiments are down. Same thing on the home builder side. So consumer sentiment is down, home builder sentiment is down. That's one that we'll have to watch out for because it's always very difficult to quantify how that would translate to hard data, how it would translate to consumer spending, and how that would translate to investment, residential investments.
Thank you, Olu. Now, one of the things I've heard a lot about is that the limited housing supply is kind of holding up at least the prices in the U.S. home market. Sarah, um, what are the supply and demand dynamics shaping the market this year?
Yes, thanks, Justin. Limited supply, definitely an issue, will continue to be an issue this year. Supply is still lower than in the 20 years prior to the pandemic, and that's due to below replacement construction costs, or excuse me, below replacement construction and low existing home supply. We expect the limited supply to drive home price growth. The growth will also be affected by higher construction costs that we've talked about that will be passed through to buyers. So we're forecasting home price growth in the low single digits in 2025. Unfortunately, we don't see supply improving much this year. We're forecasting flat to declining housing starts and completions relative to 2024. And demand isn't going to get much better either. Prospective home buyers have already weathered higher rates and higher home prices, but with these new pressures from the tariffs that we've been talking about, which not only are going to raise home prices, but obviously raise goods prices more broadly. We expect these pressures on consumers will cause demand for housing to decline and may limit the rise in home prices.
Now, the U.S. is obviously a very large country. Could you briefly talk about any regional differentiation, which is talked about in that cross-sector housing report?
Absolutely. So obviously, there's been some regional differences, largely due to the surge in migration during the pandemic. We saw a lot of people, domestic migration headed toward the south, and this led to meaningful increase in new housing supply in certain areas as home builders were working to address the higher demand in certain states in the south. So this excess supply that we've seen, particularly in Texas and Florida, which had seen strong pandemic home price growth, have now seen home price growth rates below the rate of inflation. Conversely, the Northeast has seen above average home price growth because they've had lower levels of new home supply. And Connecticut, New Hampshire, Rhode Island, and New Jersey are the states that are leading all the states in terms of year-over-year home price growth.
Speaking of the costs of homes, Olu, if I could turn back to you as our economist on mortgage rates, they remain elevated. There's been a lot of change in inflation, interest rate expectations for the wider economy as a whole. Where do we see rates heading for the rest of 2025?
I would say, if you look at where we are or where we were before the tariff announcement on Wednesday, rates were around 6.6 to 6.7%. Now, fast forward to today, post the announcement, we're seeing the 10-year Treasury yield move down quite aggressively, and that has that ripple effect on mortgage rates. The 10 years moved down by about 40 basis points, and I would expect mortgage rates to trend down more or less with the same degree of magnitude. So you're probably talking rates of about 6.3%, a lot closer to 6 compared to a week or two ago. At the end of the year, we do have a forecast of about 6.5%, so kind of pretty much where we are. But again, speaking of conviction, if we have a recession, and I hate to bring up the R word, if we do have a significant downturn, I expect the 10-year yield to move much, much lower. And the effect that that will have on the mortgage rate is we may end up seeing mortgage rates pretty much close to 6, maybe even slightly below. Now, what does that mean for the market as a whole? Usually, anytime the mortgage rate declines, you tend to see people come off the sidelines to purchase homes because you still have a lot of affordability issues out there. But at the same time, you cannot discount the likelihood that consumers will be generally scared, particularly if the unemployment rate starts to increase. So it's a combination of those two factors that we have to be very, very mindful of. I can't tell you that I know exactly how that would play out, but nonetheless, um, if things are generally stable, a big if, I think we're looking at rates at probably somewhere around where we are, maybe trend lower given everything that's going on.
And finally, Sarah, so speaking of rates, what do you think is the outlook for the effect of high rates on borrowers and asset performance? I know you work a lot with our structured finance team.
Yes, I mean, it's interesting, as Olu says, it's really uncertain in terms of some of these dynamics and how they're going to play into home prices and affordability. But I think because of the limited supply that isn't going to be reconciled anytime soon, we're still going to see one of the lowest levels of home affordability that we've seen in decades. I mean, we're at that place now. The typical income required to qualify for a home purchase has doubled since 2020 and is higher than the US median family income. So I don't really see that changing much this year, even if rates come down and mortgages become a little bit more attractive or affordable. But we also see, as we've talked about, that these higher home builder costs due to tariffs and labor supply issues will ultimately be passed through to home buyers via higher home prices. So that's going to keep upward pressure on home prices and keep affordability low. Not only higher home prices, but taxes and insurance payments have also been increasing. These are part of all-in housing costs. So it's really not a good outlook for the affordability picture this year. In terms of loan performance, mortgage delinquency rates remain low due to the prevalence of low fixed-rate 30-year mortgages. But there's been a small, steady increase in mortgage arrears due to pressures on weaker borrowers from high mortgage rates and higher all-in costs. We expect Fitch-rated RMBS loan performance to deteriorate slightly in 2025 as debt-to-income ratios increase.
Okay, well, thank you very, very much, Olu and Sarah. And as always, thank you very much to our listeners. If you'd like to learn more about Fitch's credit ratings, analysis, and research, please visit our website at www.fitchratings.com.